I think one of the perspectives that we can give people is just how around the world people are seeing different things and in a different place based on, how long they've been living with this virus and the opportunities locally. So, for example, in Asia, we do have a lot of clients who are looking at global opportunities and looking at things like the 5G rollout in Asia, which could be accelerated out of this crisis or because of this crisis, and looking for opportunities.
So it wasn't that long ago where it almost seemed like you could throw a dart and have a decent return. And now perhaps it's quite the opposite. So do you have to be very careful with what you're investing in right now? As you mentioned, 5G, that's a very particular play.
Well, it's a great question. I'd like to think that we're always trying to be careful and uncover opportunities, whether they're relative value or absolute values. I think that, as we're looking at the scenario right now, you mentioned this dip in economic activity. But it's not, investors have to focus first, it's not just the dip, it's also this bending of the curve in the new virus cases, and then, of course, the filling of the gap with the policies now. And so as these policies roll online, there could be winners and losers. I think one of the shots that you just had was on the airlines, which are kind of smelling out perhaps that there will be some action in these new bills and then laws that are going to support them a bit. So you do have to be nimble, yet we do see already some opportunities that are probably emerging.
I think many people that study the stock market understand that in the long run, we do see equities rebound, but we have no idea what that timeline might be like. What if you're someone that's looking to retire or is just recently retired and really counting on that investment income? What's your advice to those people?
Well, I think that, one of the things that we get asked a lot, particularly now when things have sold off, of course, is, well, how do I hedge here further? And that's kind of what you're saying. And I think the most important advice, I think we can give at a time when a lot of the hedges simply are not going to work given the fear in the market, is asset class diversification and geographic diversification. We had 7 pandemics between 1900 and 2000. We had sovereign defaults. We had wars, revolutions. The people who really suffered irrevocable losses were those who were just concentrated in one region. There was rarely or never somebody who was globally diversified, always had something to rebuild on. And I think if people start there, develop a plan where they have liquidity so they know they can survive for a year or two, then they begin to see these sell-offs more perhaps as opportunities rather than things that they just totally freeze up or sell everything.
And so you point out geographic diversity, and I know that you're interested at least looking at emerging markets or changing your strategy there. Can you explain to us your current thoughts for EM?
Absolutely. So we think that some of the credit markets, the credit space, the emerging market, dollar, sovereign bonds have priced in more of a recession than equities broadly. And so we would look for that to be a space that can help lead us out of this. We also think that U.S. high yield can help lead us out of this. So again, it's that asset class diversification, a real kind of multi-asset portfolio view that can help people as we start to rebuild. But we also recognize as the news about the virus comes through, it's going to be choppy here. But I think this Fed move, you see it in the dollar, you see it in the VIX coming down, that some of the stability is starting to come back to the credit markets, and that's a first step.